Hi everyone, in this video we are going to continue analyzing the concept of LIFO reserve and the impact of the changes of LIFO reserve on tax savings and retained earnings. As you may remember from our previous videos, the LIFO reserve beginning was 0 because the company we are analyzing just began operations in year 2000 XX. So change in LIFO reserve was 5,000, ending LIFO reserve was also 5,000. Now let's take a look at the following year, the year 2000 XY, and see what happens when they keep buying additional units and how their taxes and net income are calculated and the changes in LIFO reserve. So what we are saying is in the following years they're buying 3,000 units for $15 per unit, and then they are selling 1,000 units at the price of $20. So their revenue is 1,000 units multiplied by 20, and now we need to calculate cost of goods sold. Under FIFO, let's make this clear. This is the FIFO section, and this is going to be our LIFO section. Cost of goods sold is first in, first out, right? So they are selling 1,000 units. These came in last, so we don't have to worry about them. There are still some inventory left under FIFO, and that particular inventory is going to be coming from here. So we haven't used these ones. We need to use these first before we start using the 3,000 units. As a result, our cost of goods sold, we are selling 1,000 units, and the price for that is going to be $14. We used all these first three, and now it's time first in, first out. Now it's time to use partially this part. So our cost of goods sold is $14,000. Our income before taxes is $6,000. Our tax rate is 10%, and our net income turns out to be $5,400. Let's take a look at LIFO. Sales is going to be the same regardless of inventory valuation. So our sales is going to be the $1,000 multiplied by 20. Our cost of goods sold is going to change, last in, first out. So we are going to assume that they are selling these units. They are selling 1,000 units at $15 per unit, last in, first out. Then we can calculate pretty much the rest. Income before taxes, we are going to calculate the tax rate, and we are going to calculate the net income. And then let's start looking at the ending balance of inventory under FIFO. And what we are going to do is we have used in these 2 years, we have used, in the first year we used these under FIFO, and we used 1,000 of these. So another 1,000 at $14 is left under FIFO, plus we still have the 3,000 units that we haven't sold for that cost us $15. So this is the ending balance inventory under FIFO. Under LIFO, the situation is a bit different. So under FIFO, what we did was we used these units, and what we haven't used is the 1,000 unit from the previous year. Remember, we used 4,000 of these guys, so 1,000 is left. Plus, we haven't used this, multiply by 11, plus what's going to be left is we still haven't used the 2,000 units. We bought 3,000, we used 1,000 here, so We still have 2,000 units remaining at $15. So this is going to give us the ending balance inventory for under LIFO. In the next video, we are going to continue looking at the LIFO reserve, the change in LIFO reserve, and ending LIFO reserve.